Welcome to the fourth quarter 2019 earnings conference call. My name is John and I'll be your operator for today's call. At this time, all participants are in listen-only mode. Later, we will conduct a question-and-answer session. During the question-and-answer session, if you do have a question, press star then 1 on your touch-tone phone. Please note that this conference is being recorded. And now I'll turn the call over to Vernon Hill.
Good afternoon. Good morning to everybody. We have with us today on the fourth quarter call for Republic Bank. Frank, introduce everybody, please.
Yep, Frank Cavallaro, Chief Financial Officer. We have Andy Logue, our President and Chief Operating Officer. Harry Madonna, President and CEO. And finally, Vernon Hill, Chairman of the Board.
Okay, thank you all for dialing into the call. The press release is out. Highlight the items in the release, and then we'll talk about whatever you would like. We had another great quarter of growth. Deposits year over year have gone up $600 million. Our new stores are growing at $30 million a year, and all of our stores, counting a few old ones, are growing at 22. We have 2 stores in New York open. They're doing very well, and the third one about to start. Loans also grew very well. They grew 22%, and they're growing in every market. This was a third quarter, I believe, or the second quarter, where we have a small loss. As I think I mentioned at the last quarter, we had an unusual set of facts where we had the expenses, particularly of New York, but the flat to inverted yield curve compressing our margin. We're going to talk about the things we are about to do, or I started to do, until the margin improves. Again, the margin's the problem. You have a flat or inverted curve. One of the ways we're improving our margin is our loan-to-deposit ratio will be going up. On page 2, everybody asked about tech. I'm pleased to announce that we have brought on board Jack Allison, who worked for me at Commerce as a chief tech officer from like 91 to 2010, and he helped lead the tech transformation of Commerce during all of those years, and he's already improved not only our back office but the delivery experience to our clients. Republic is about the integrated delivery experience of in-store, mobile, online, and as you know, our theory is about building fans. You can see the growth in assets, loans, and deposits. Frank, the deposit growth in the fourth quarter was what here? I missed a quarter here. $200 million something?
Yeah, approximately $200 million for the third quarter alone.
Right.
Fourth quarter.
Non-performing assets went down, declined to 0.42%. Our largest ORE asset was sold off in the fourth quarter. Our residential mortgage business is doing fine for the year, and SBA is important. Capital is still fine. But as these growth rates grow at these rates, we said we expect to raise capital in some form later this year. We don't have a date. So we've also announced that in response to the margin, we've introduced, which has begun already, a dramatic reduction in expenses and expense growth. Frank, why don't you go through that?
Yeah, so the first item on our list is to slow the store openings. We've announced previously that we expect to do 4 stores this year. Most of them were already under construction or far along in development where we found the need to continue with them. But that'll certainly help us control the expense growth. We're looking at control of new hires as well as other variable costs, things like marketing, maintenance, and professional fees.
One of the things we've done in this new world of tech, we've actually reduced the hours of the stores, which I've never done in my life, I don't think. It's still very long hours, the best in the market, but we've reduced some of the weekday night hours and some other hours. We've got some real cost saves there. Go ahead, Frank.
We've taken a very close look at all high-cost deposit relationships in an attempt to drive down the cost of funds. As Vernon mentioned, we hired Jack Allison as our Chief Technology Officer. We will use Jack to optimize the use of all technology resources We're assessing the size of future stores. We'll try and optimize and limit any costs or expenditures there. In addition, we've taken a close look at management salaries as well as board fees and the bonus pool that we accrued for 2019. So all those initiatives together, most will take effect in the first quarter of 2020. But if you look at the earnings release, you can also already see the stabilization of non-interest expenses. Non-interest expense actually declined slightly during the fourth quarter of 2020.
I think everything else is covered in the printed release and the online release. We'd be happy to open the floor now to what you would like to ask.
Thank you.
Fire away.
Thank you, and I'll begin the question and answer session. If you do have a question, press star then one on your touch-tone phone. Once again, if you do have a question, press star then one on your touch-tone phone.
Anybody there?
And our first question is from Frank Schiraldi from Piper Sandler.
Good morning.
Frank, we're confused. Frank, we're confused with your new name.
It is confusing. I know it's different, but not much else has changed besides the name, so that's good.
Okay.
But I wanted to start, Vernon, with actually, Frank. I think you might have just mentioned. I might have just missed it. I thought you guys had talked about the number of branches next year you were looking to open was 4, and then I'm not sure if you updated that on the call here this morning.
No, we said at this time 4 is the target for this year. 1 already opened in January. There's another one under construction that will open late second quarter, and 2 more that are far long enough in the development process that it doesn't make sense to slow them down at this point.
But Frank, that is slower than we had in our plan last year. We tend to build more new stores in both markets. We deliberately slowed down these store openings. Go ahead.
Okay. Right. No, I understand. Okay, so 4 for 2020, and then Vernon, you mentioned the loan-to-deposit ratio should be going up. Frank, you talked about taking a hard look at some higher cost deposits. So, is this something that we should expect, just stronger loan growth throughout the year than deposit growth, or is there, something in the first quarter where we could see some attrition in the deposit levels just right off the bat to kind of reduce some of those higher, cost deposits?
Our loan-to-deposit ratio is definitely going up. The New York expansion has really helped. As I found when we went at Commerce to New York, there's more commercial loan demand, and the rates are higher in New York. It's surprising. So we grew. We had a big fourth quarter. What was the loan growth in the fourth quarter, Frank?
Loan growth in the fourth quarter was $175 million, and a lot of that was in the back end of the quarter.
And how's that compared to the third quarter?
For the first 9 months altogether, it was only $130 million.
So we grew more than the fourth quarter in loans than we did in all 3 of the first quarters. It's coming from every market, but as I said, Frank, I was really surprised when Commerce went to New York. There's more loans in our segment, and the pricing's higher. So pretty confident the loan-to-deposit number is going to keep going up, which the margin will get helped, of course.
Okay, so it sounds like it's more a case of just tremendous loan growth as opposed to trying to cull, part of the deposit franchise.
I wouldn't say we're trying to cull the deposit franchise. There's always outliers you can dial back. Their deposit growth is so strong now that we can be less aggressive on certain types of products and rates. Do we have the deposit growth slowing this year, Frank?
No, but we have loan growth accelerating further than we had in past years.
Okay. All right, gotcha. And then just on the capital front, you mentioned, Vernon, I think you'd have to address some form of capital just given the way you're growing at some point later this year, I believe. So I just if that's the case, then doesn't sound like you're looking to do something immediate. But just kind of curious if you could give us a little bit of detail on your thinking on common levels, because to me it seems like you're gonna, just given this growth rate, you'll have to raise common at some point. Just curious if you could, tell us what sort of levels on a TCE ratio you guys target, and how low do you think you can go on a TCE ratio at the holdco before you need more common?
Right. We're thinking about doing something in the second or third quarter. We're not committed to that. We do need common in some form. You've heard me talk before, Frank. I've done converts several times, and it's a possibility to do some kind of convert, whether it's a preferred or debt. Generally, my experience and what we've had at Republic is we raise capital and we sort of work it down as it grows, and then we raise some more. We're not ready to say what the amount is, but it's not a giant number that we need.
Okay. I mean, do you think you go back above? I mean, any sort of color or guidance you can give us on just where you think you guys need to get on a TCE ratio in order to once you raise some money that you don't need to raise again for another 18, 24 months, something like that. Where do you think you need to get to on a TCE ratio?
Yeah, we're certainly going to keep it above 7%, but we're not specific about how much we want to get above that number in the next raise. So as we see how the first quarter goes, we'll get back to the market and talk about the range that we expect later this year.
Okay. All right, great. Thanks.
Thank you, Frank.
Our next question is from Michael Credo from KBW.
Hi, Michael.
Hey, good morning, Vernon. How are you?
Good, thank you.
A couple follow-up questions. So as we think about, just on Frank's capital question, but as we think about the overall kind of asset growth for 2020 with the 4 stores, do you guys have any initial thoughts on kind of what your expectations are there, especially with kind of, the revised up loan growth expectations that you discussed earlier on the call?
Do we have any expectations about what the...
Overall asset growth, like if we're trying to think about the size of the balance sheet, just as we're trying to think about capital and levering capital.
Yeah, well, you can look at our deposit growth per store for 2019, and we're pretty optimistic it can continue in that area. But remember, when you talk about new store openings, you have to count the months they're open, not the year. So you just can't add 4 of the stores and multiply that number. But generally, it'll be in this area per store.
Okay. And then on the expense kind of actions that you guys sounds like have already started to take, Frank, I was wondering if you could give us a little bit more details about how you kind of expect that to impact the near-term expense run rate, and I guess just more specifically, do you think by the second quarter of next year, with the actions you're taking, that you guys should be able to kind of return to a positive earnings run rate here, or do you think it'll take shorter or longer than that?
That's our expectation. A lot of these initiatives were set up to start with the beginning of the new year. You can already see the stabilization, so you've got some impacts that are taking effect in the fourth quarter. But that's clearly it's a priority for us right now.
So remember, Mike, that the new store openings are a decreasing percentage of the total store base. Mm-hmm. So the new stores have a less negative impact because they're a lower percentage. But we definitely expect it to get back on course soon.
And does the expense, does it actually step down, or do you think it's more of a stabilization with the loan growth and the NII benefit on top of that?
It's a combination of two. So the initiatives are a combination of both. Some of them are reductions, and some of them are controlling with the future growth. Obviously, if we continue to grow the balance sheet at the same rate, managing expenses to be limited is really a priority and should show the benefit.
Well, you also get some top-line improvement as the margin improves, and we're very optimistic about loan growth, which is going to increase the margin and the top line. So they're sort of both working together, we hope.
Okay. And I don't know if you guys could answer this, but just as we think about the margin, it was 267 in the fourth quarter. Obviously the New York market is a small relative piece at this point, but growing rapidly. But it sounds like the margin in the New York business is stronger than the rest of the business at this point. I was wondering if you could maybe just disclose where kind of the margins are ranging on the New York business, just as we try to think about how the NIM could improve as that becomes a bigger piece of the overall company.
Historically, that was my experience at Commerce. The margins were better in New York because the loan yields were higher and the cost of money was no higher. It's too soon to tell on that, Mike, because stores open and they have opening deals and you're working with a small number. I think long run, we think the margins are going to be about the same there. But as you've heard me talk for 100 years, it's all about deposits per store. And you're going to get much higher deposits per store than you would have in the Metro Philadelphia market and any suburban market. So over time, the earnings impact in New York is much better because the average deposits per store will be much higher.
Got it. And then just one last quick one, if I can sneak it in. But just Vernon, you mentioned that you're trimming store hours. I was just curious, has that been communicated yet, and has there been any kind of client feedback on that as you sit here today? Thank you.
Andy?
Yes, it's been communicated out, and there's been no feedback.
It's been installed.
It's been installed. Yeah, I'm sure.
To be frank, Mike, you know me, I like these long hours, and we haven't cut the hours about 7 days a week. It's more the fringe hours. We couldn't cut out 7 days a week, but it's obvious to everybody that people don't use the stores as much as they did because of online and fintech. So we've made a savings, and I haven't heard a thing back yet. Have you, Andy?
No, again,
you hear?
No responses.
So
you know what,
guys,
I think it makes sense. So that's good to hear that the feedback has been different.
You know, our stores are. You know, we spend very little on marketing. Our stores are on marketing. And it's in the new world, it's about the right balance between stores and online and fintech. And these growth numbers for these stores, guys, you all know that American Bank branches grow 1 to 2 million. Our branches, our new ones, are growing 30 million a year, guys.
Got it. Well, thank you for taking my questions. I appreciate it, as always.
Thank you. Anybody else?
Our next question is from Brian Meisner, a private investor.
Hi, yes. Thanks for taking my question. I was just looking at the non-interest expense category and specifically the other operating expenses. I was just wondering if you could maybe break out the growth-related expenses in that category. Is that something that you guys could do? I'm trying to get down to kind of like the profitability of outside of the growth. I'm trying to get like a run rate, basically.
There will be more detail in the 10-K that we file in a few weeks. Other operating expenses is really a catch-all. There's T&E and marketing, advertising. It's a large bucket that we summarize for purposes of the earnings release, but we will provide more detail in the annual report.
When we're out on the road next time, or when we do another calls, we'll break out the store profitability model, and then the back office expense model will show you how it all works together. You might, I don't know you, Brian, but the old days of Commerce, we did profitability models by store and back office, and we're prepared to do that again soon.
Oh, okay. Oh, that'd be great. All right. Thank you.
Sure.
And we have another question from Frank Schiraldi from Piper Sandler.
Frank, are you back again?
Just one follow-up, if I could. First, I just want to say, yeah, definitely, if that would really be great if you guys would provide that again sometime soon. That would be really helpful. So look forward to that.
The next release we put out, if not sooner, soon we'll come out some breakdowns of stores, and we used to report at Commerce the break-even level generally, and the flow-through profit. So we will report some of that at the next report. Republic never had enough size and experience for the numbers to have a lot of meaning, but we're getting to that scale now.
Okay, and then just wanted to try and zero in on expense a little bit more, just big picture for 2020. Frank, you talked about the fact that expenses stabilized in the fourth quarter, which they did. They were down linked quarter. With the growth you're looking for in 2020, with the 4 branch openings, I'm assuming you're still going to see some expense growth here. If you could just characterize for us, is that some sort of, normalized growth more in line with what we saw in 2018, 10% sort of growth from these levels, or any sort of color you can give on just sort of, when you talk about cost control measures, how much is stabilization and how much is just controlling growth from here?
Frank, maybe it'd be helpful to everyone if we gave you some numbers about expense growth excluding the new stores and break the new stores out. See if that helps, and we'll come out that we'll share with the market that will give you some more numbers to work with.
Okay, so at this point you're not prepared for to talk about, I guess, growth in expenses for 2020 year over year.
Are you, Frank?
We can only disclose so much, Frank, but adding 4 new stores is obviously going to drive more cost. The other initiatives, like managing raises and merit increases and advertising, that'll offset some of that growth. So, you saw the percentage in the growth year over year in 2019. We're clearly not going to, reach those levels. Hopefully we'll be back closer to that 2018 level that you referenced, but, somewhere in between is probably a reasonable assumption.
Okay, great. That's helpful. Thank you.
Anybody else?
At this time, I have no further questions.
Thank you all. Call Harry, Frank, or I. Goodbye, everybody.
Thank you, ladies and gentlemen. This concludes today's call. Thank you for participating, and you may now disconnect.